No.
There you go.
Okay. Okay, 1 second.
Okay, I think we're going to start. Okay, thank you. Thank you.
I'm going to mute myself temporarily, but that little thing.
All right, I'm going to start, Maria. Okay.
Thank you.
All right. Good morning.
I'll call you
Thank you
back.
for joining us October 24th for the Chicago Teacher Pension Fund Investment Committee meeting. For the record, I'm Philip Weiss, chair of the committee, and the meeting is being held in person at our offices, 425 South Financial Place. The investment committee is a committee of the whole and includes all CTPF trustees. The committee is primarily responsible for decisions regarding the board's duty to invest CTPF's assets. A quorum for this committee is 7 trustees. Please note the following. Access instructions for remote attendance and instructions for in-person attendance have been posted on the fund's website. All participants, please wait to be recognized by the chair before speaking, and please limit discussions from each trustee to 3 minutes. Please note that for our staff and trustees to focus on the business of the meeting, we will not be responding to messages from participants using the Zoom chat feature. Please forward your questions to member services at ctpf.org. Member services at ctpf.org. We'll start off with public participation. Do we have any members of the public who wish to be heard? Please raise your hand or send a note in the chat, and please limit your statements to 3 minutes. Thank you. Do we have any members of the public? Oh, please, and thank you.
Good morning, members of the Board of Trustees and staff and visitors. It is with humility, pride, and joy that I sit before you today celebrating 39 years at the Chicago Teachers Pension Fund. Thank you. I've served in several capacities, but most notably and most passionate to me is the work that I've done for you, the Board of Trustees, over the years. Supporting the Board of Trustees has been something that I believe is quite important as you carry out the mission of the fund by doing your fiduciary duties. I haven't been able to do it alone, and I just want to say thank you to the Board of Trustees. Thank you to my wonderful team. I can't do it without my team. And thank you so much to our fearless leader, Carlton Lenore, who actually came along on this journey 4 years after I did. And we have been traveling along ever since, not knowing where we were going to land. And here we are today. Carlton is our leader, and I carry several roles at the Chicago Teachers Pension Fund. But again, I started this journey in 1984, and it was under the leadership of James F. Ward. I didn't know anything about a pension fund, didn't know anything about trustees, and certainly not an election. And Mr. Ward asked me, can you work the election on Friday? And of course, I'm happy to get a job. And I said yes. And here I am today as election coordinator, still working on elections and hoping that is just as successful as the day that I started. And again, thank you very much. And I am proud to be here.
Thank you for your service.
Yep.
You have done an exceptional job.
Did you want?
Yes. Yes, so thank you, Chair. Gail, just wanted to, on behalf of the fund, thank you for your tremendous service to the fund, the passionate leadership that you have had. We've been together, like you said, for 35 years of that 39-year journey, and you've always been so positive and passionate about everything that you do with impeccable grace and style. So thank you for this milestone and continued success.
And we have cupcakes. Please help yourself to cupcakes. Please get some this morning.
It's like prom.
She went back.
Thank you, thank you. I'm glad I'm not running against Gail Davis now. What passion. Um, Yes. I'm going to move on if that's okay. I know that we have one person in public participation here. Is that Tina? Is she here? Tina Padilla? Are we on? Is she on? I think we have. Tina, can you hear me? Tina?
Now I can.
Oh, okay, very good. Good
Hello,
morning.
everybody. Good morning to you all. Thank you very much for your service. You know how much I really appreciate what you're doing, and I am going to do it alongside of you, whomever 12 people are sitting on that board. This is also a passion of mine to protect the hard-earned money of teachers. Teachers are my people. Thank you, Trustee Phil Weiss and Tammy Vincent, Trustee Tammy Vincent, for attending the Pension Advocacy Group Candidacy Forum. I thought it was very successful. And of course, we're just going to build on the things that were good, hopefully eliminate the ugly and the bad for the next time. The one request or concern is, as a representative of a nonprofit organization, I don't only have to tell my board what I'm doing on the behalf of our organization, but also I have to show them. And I noticed on May 23rd, because this is my evidence that I'm doing what they're asking me to do, I saw that there was no public participation, and that but on the second there was. You include public participation in the minutes. What I'm trying to get to is that is my evidence that I'm doing exactly what my board is asking me to do for them. I use the minutes as my proof. So I would, if there's no public participation, if you could just say no, something or another. And also, maybe if you guys could use a transcript, if you could consider enacting the ability to record it as a transcript. I know the technology is there, and I think that's best practice. Being in the industry and being in the time frame, we should have, along with the minutes, transcripts at this time. And those are, I know you can't answer my questions at this time, but I did want to thank you all for participating. We are going to work alongside you all and help you in any way possible to balance that equation. It's a simple, basic equation. And I'll say something about that equation at the next meeting. Thank you. Thank you for your time.
Thank you, Tina. Thank you. Do we have anyone else? Do you see anyone else? Is there anyone else? I didn't see anyone. Okay. All right. Why don't we move on to roll call, please? Thank you.
Trustee Blackwell,
Present.
Trustee Nelson, Trustee Ochoa,
Present.
Trustee Price Ward,
Present.
Trustee Riley,
Present.
Trustee Rodriguez.
She's not in.
Present remotely, but you didn't go, no one, well,
Okay,
We'll get there. We'll get there.
okay, thank you.
my apologies, I'll get there later. Trustee Trevlos, Trustee Benson,
Present.
trustee Washington,
Present.
trustee Weiss,
Present.
trustee Woods. That concludes roll call.
Can you we have seven, correct? Seven present. Okay, good. So since we have a quorum on site, our first item of business will be item 3, approval of remote trustees attendance who have joined us. So how many do we have remotely? One?
As far as I'm not logged in on Zoom, but
Okay. The Open Meeting Act allows for remote participation by a trustee if a quorum is physically present, which it is, and the member cannot physically attend due to personal illness, disability, employment, or public body business, or family or other emergency. So Maria, do you meet one of the categories?
No, I do not. Is the attorney there today?
yes, I am here. Trustee Rodriguez, can you hear me?
Yes, okay, I can hear you now. I couldn't see you on here. Yeah, I don't believe I qualify for any of them. I do have something I have to take an appointment with a doctor, and that's why during lunchtime, that's why I'm not attending. So I don't know if that would qualify me or not.
So are you saying you have a doctor's appointment today or? you're
No,
waiting?
today, yeah, in between during lunch.
I would allow that. I would allow that to be a remote attendance, so the board would have to vote on that.
Yeah, okay, very good. I agree with that. I mean, I concur. So do we have is that the only one? The only one remotely, correct? That I know of?
I don't see, I don't have we didn't get a Zoom link, so I'm just going by.
Yeah,
what I see.
I've got it up here. Okay, do we have a motion for the on-site trustees to allow trustees attending remotely to fully participate in the meeting?
So moved.
Thank you. Second, trustee Vincent. Roll call?
Trustee Blackwell,
Yes.
trustee Ochoa,
Yes.
trustee Price Ward,
Yes.
trustee Riley,
Yes.
trustee Benson,
Yes.
trustee Washington,
Yes.
trustee Weiss,
Yes.
that's 7 ayes.
Seven ayes, very good. Okay, so passes. We'll continue to item 4, the approval of the May 23rd, 2023 Investment Committee meeting, committee minutes. If you want to just take a moment, take a look, and then when you're ready, if I can have a motion to approve the minutes, I would appreciate it.
So moved.
Second.
Thank you. Please call roll.
Trustee Blackwell,
Yes.
trustee Ochoa,
Yes.
trustee Price Ward,
Yes.
trustee Riley,
Yes.
trustee Rodriguez,
No,
trustee Benson,
Yes.
trustee Washington,
Yes.
trustee Weiss.
Yes,
That's 7 ayes and 1 nay.
very good. I just want to mention there's a typo for Tammy Vincent. Her name is misspelled in the minutes. So I think I just want to make sure we get it spelled correctly on the right below the roll call, correct?
Yes.
Okay.
I just want to get on, period. To the. Well, here too.
Okay, I'm going to move on to the next item here. I want to approve the August 22nd, 2023 Investment Committee meeting minutes. So August 22nd, 2023. Do I have a motion to approve these minutes?
So moved.
Second.
Thank you. So Tammy, trustee Vincent, and then trustee Ochoa. Roll call, please. When you're ready.
Trustee Blackwell,
Yes.
trustee Ochoa,
Yes.
trustee Price Ward,
Yes.
trustee Riley,
Yes.
trustee Rodriguez,
no, at this time.
trustee Benson,
Yes.
trustee Washington,
Yes.
trustee Weiss.
Yes.
That's 7 ayes, 1 nay.
Okay, so thank you. The motion passes. So we will move on to item 5, which is fixed income structure and implementation, which will be by our consultants, Brandon Angel. Thank you. Whenever you guys are ready. Thank you so much. Thank you.
Great. Good morning, everybody. We are going to talk about our fixed income structure study today. So we've been going through the fiduciary process this year. We started in February when we did an asset allocation review, and now we're drilling down into each of the asset classes. So we did international structure earlier this year, and today we're working on fixed income. So in the presentation, if you can go to page 2, just to give some background for today, we did our asset allocation in February, and at that point in time, the board approved increasing the fixed income allocation from 23% to 26.5%. A little bit of an overall de-risking with higher interest rates. And then as of the end of June, your actual fixed income allocation was 18.6% of the fund. So after we do the structure study and any affiliated searches, we'll be moving about $900 million from other asset classes, mostly international equity, into fixed income. So one of the reasons we want to look at the structure is because we are adding a significant amount of assets into the asset class. We want to make sure we have the right managers in place. Additionally, what we're going to talk about today in our recommendation is removing the passive allocation, which is that State Street passive bond index, the one they're on watch right now for not meeting their minority brokerage requirements. So we'll be talking about moving that asset or that allocation into active management. That's $400 million. So overall, your active managers will be getting an additional $1.3 billion in assets once we've moved forward with the new asset allocation. So for that reason, that's really our goal today, is to figure out how we want to allocate how many managers and how much to each manager. So going to the next slide and taking a little bit of a back up and looking at, the purpose of today's structure. So Callan has some philosophical tenets that we use when we're putting together investment structures. First, we want them to be long-term in nature, durable. We're not trying to time the market. We want this to be an all-weather portfolio. We want to keep it simple. When plans are trying to put together overly complex structures, they don't necessarily have better outcomes, and they're not very well understood necessarily at times. And so we want to make sure that we keep it simple, easy to understand, so that everybody's aware of what we're doing here with the fixed income allocation. And then last, we want that to be cost effective. So cost effective can mean using passive management where it makes sense, but it also means allocating the right amount of assets to each manager in order to get a reasonable fee. And so as we give managers more money, we do renegotiate fee structures as well. That's just kind of part of everyday business. And so we've looked at the cost effectiveness of the structures in our analysis. So on the next page, we talk about the guiding principles of fixed income. This is really the diversifying asset class of the portfolio. It diversifies all of the other allocations. So it's diversifying your equity, both public and private equity, your real estate allocation and infrastructure, and is that low risk alternative. So we want to maintain that principle when we put together the portfolio, that this is the anchor to windward. It's less correlated with the other asset classes as well. And so that's really what we want to focus on when we're putting together a fixed income structure. An example of that is on page 5. And what we've done here is we're looking at the correlation of equities and fixed income. So when equities go one way, what direction does fixed income go? And typically, you can see the black lines here are the S&P 500. The blue lines are the Bloomberg aggregate, which is our fixed income market proxy. When the black lines are down, most of the time, fixed income is up and positive. There's been a couple of time periods when that hasn't been the case. If you look at the far right, the time period between the whole year of 2022 and the first 6 months of this year has been very tough for both fixed income and equity, and that's due to the really high inflation, and then the Fed increasing interest rates significantly over that time period. So it's been a little bit of a double whammy. This is only the fourth year, 2022 is the fourth year in the last 100 years that we saw equity and fixed income negative, both at the same time. So it's a very rare occurrence. And then the other time that this happened was the first 6 months of 1994, which was another bond market crisis. And it was a year when interest rates were also increased pretty significantly. So starting the year at 3%, ending at about 5.5%. So it's another one of these times where we've seen that increasing interest rates. So there are periods of time when bonds and equities will both decline, but generally this is the most diversifying asset class that we have. On the next page, we talk about the different types of fixed income strategies, and there's two main types of managers that we recommend. Traditionally, core is how we describe managers that are investing in the types of securities that are in the Bloomberg Aggregate Index. So this is all investment grade bonds. So it includes treasuries, it includes corporate bonds, it includes mortgage backs, but all above, investment grade. This would also be your passive allocation would be core, considered core. So you've got core passive, you've got core active. And then the other category is core plus. So core plus can only be active, and it allows managers to invest in bonds that are outside of the Bloomberg Aggregate Index. These are typically a little bit higher risk, a little bit higher return, like high yield bonds, global bonds, bank loans, emerging market debt. So some securities that aren't in that investment grade only index. And it tends to be about, on average, 30% of the portfolio in these plus sectors. So you're getting core and then you're getting a little bit more from that. Both of the strategies are benchmarked to the same index, the Bloomberg Aggregate. So as I'll show on the next page, core plus tends to outperform because they do have that ability to go outside of the index. So the last page I'm going to cover is on the active manager performance. And, the bottom line is we recommend active management and fixed income. The blue bars on the left side of this page, what they're showing is we looked at 3-year periods. So every 3 years, we rolled it forward a quarter and then a quarter, and we looked at that 3-year period over the last 20 years. So all of these 3-year periods over the last 20 years, we said, okay, how often did the median manager in the universe outperform the index net of fees? And that was 76% of the time for core and 84% of the time for core plus. We also use these kind of generous fee. We use 25 basis points for core and 30 for core plus, and your managers are below that at this point. But overall, it just makes much more sense to be active in fixed income rather than passive. We also, for context, looked at your fixed income composite, and you've outperformed every trailing time period, at least up to the last 10 years. And that included that passive component that wasn't adding any value over the benchmark. So you've had a lot of success with active managers in this asset class. And so that's why, we'll be recommending moving to an all active portfolio. Are there any questions on that before we get into our structure recommendations?
So let's hold that for a second. Yeah, any questions? Because I know that people have said things. Mary Sharon, please. Thank you.
Fees.
Mm-hmm.
Passive is what?
The passive is 4 basis points.
And active is?
The core fund, I don't, John, do you want to talk about this or do you want me to?
I can get the exact figure, but we did a fee study, if you remember, earlier this year for the board. I mean, Callan did it. We looked at each asset group. So for fixed income, we're well below the median. And I want to say average, again, I can get the exact number, but between 13 and 14 basis points, which again is much lower than what Callan even used for this particular illustration. So we're lower than the market as a portfolio, and each of our managers is lower than the market individually.
I mean, initially, and I'm going way back, the mandate was, or it was in the law, we were 60% fixed income, 40% equity, with a basket clause of 10% that we could invest in equity. And frankly, I don't even remember when it started to change, because we hired, what do we hire? First, we did something with the portfolio. So we used to have one balanced manager, and then we went into 10 diversified. And then in 95, I think we hired minority managers. And only one is left, Sevenbergen. But it's been an unusual road, and I'm sure most pension funds went through it. But one of the things I still don't understand after 25 years, how do we really make money on fixed income? Because you have to think, we're making money when fixed income goes up, we lose money. But I never understood that.
Yeah, so I know you mean when interest rates go up.
Right.
Here's an example. This is the way someone described it to me when I was first in the business. So if I have a bond today and I am earning 5%, so I've loaned money to somebody and they're paying me 5%, and interest rates go up 1% tomorrow. So tomorrow, now I can loan somebody money and get 6%. So my 5% loan isn't worth as much as my 6% loan, because now people are earning more money, I'm earning more money today than I was yesterday.
Right. And
So,
people are trying to get out of the 5 then.
Right. And so that's what happens. So then when interest rates go up, the current value of bonds goes down, but that means that in the future, as you're lending money, you're earning a lot more. So what's happened over the last year, even though it's been painful because our current bonds are not worth as much, our new bonds will be worth so much more.
Right.
That we'll be earning more going forward, theoretically. So, yeah.
Okay. It'll sink in eventually. After 25 years, if it hasn't.
On the same note, so what the 30-year fixed, 30-year interest rates are currently above 8 now, correct? And we're adding to our bond portfolio. To your treasury, sorry.
About 5.1.
Do I mean I'm thinking about just 30-year mortgage rate is up. So obviously we're expanding this category. Where do our actual assumptive rate is 6.5%. As a category, where do you see our returns being overall in bonds? What percentage? Just ballpark.
So the expected return for bonds now is about north of 5%.
North of 5, okay.
And that was revised from 2%, 1.75% prior to last year. The changes we experienced in markets last year were so significant that we had to revise the expected return for fixed income to this level. So now that's your passive beta exposure. When you combine active managers, particularly in fixed income, as Brianne mentioned, you enhance the potential for that return going forward.
Yeah, but anything below 6.5%, we're gonna have to make up in other investments.
But remember, you have an
we'll have
equity,
less.
you have an equity
volatility.
component, you have private credit, you have private equity. All of those components combined will help us achieve that expected actuarial return.
With
It's not
less
just
with
the-
less volatility.
Yes,
Yeah.
that is correct.
That's the goal. So very good. Let me see if there's any. Yeah, Tim.
But they can go higher.
I'll let Tammy said.
I'm sorry, this is like a neophyte question. So I'm looking where it says with the fixed income structure, that it's low risk and some of our diversified assets for equity allocation, right? Why would this be a good time to invest more if we're not expecting greater returns?
We are expecting. So we've just lived through this period where returns are down because interest rates are higher. Now that interest rates are higher, new money going into the asset class is investing at higher rates. So that means that now loans that you're making are going to earn more money than they would have a year and a half ago. So it's a good time to get into fixed income.
Oh, okay, so it's a 1.3 billion investment, but are we saying that in the other investments that are probably paying more, they're not as viable now, or why fixed income now, I guess still my question.
Yeah, so, so equities are still a good investment. I mean, all of the asset classes are still a good investment. And generally, we're not market timing. One of the things though, with these new higher interest rates, you can earn more from your fixed income allocation. So if I take a step back, 10 years ago, you didn't have to have as much fixed income to hit your actuarial rate of return because interest rates were higher and you were earning more on your bonds. Then we went through this period where interest rates fell, which means that your fixed income portfolio wasn't returning as much. However, it's not going to lose as much as equities in a typical market environment. So that's why you had it. So, you know, last time when we were doing this in 2016, the question was, why are we having fixed income at all? It's not doing anything for us. And what it is doing is reducing the risk of the overall portfolio. But at the time, you weren't getting a lot of return.
So it's just like a cushion.
Right,
All right.
right.
That's a great word.
Yeah, and so now that interest rates are higher, this has been a good time for the fund to be able to take some of the risk off of the table and put it into fixed income, where before you needed to take the risk to get to your actuarial return.
So now we are in a situation basically where return expectations have gone up, and you can achieve that return at a lower level of risk by putting more money to work in fixed income.
I would also add that that fixed income is crucial as a liquidity source, especially when markets are turbulent. So when there's a severe downturn, you don't want to sell things that are down 20%. We can look to fixed income to pay benefits. We can get our money out. A lot of it is treasuries. So very liquid. We can get it the next day.
We don't time markings, but it's good timing, right? We're just fortunate in that respect, yeah.
Yeah.
Any other questions, trustee?
Yeah.
Here,
Well,
sure.
just
I've had my, Susie, I've had my hand up.
I'm sorry, I didn't.
Like
I wasn't
3
watching.
other people spoke before me. That's okay.
Oh, Maria, why don't you go? I'm sorry, I wasn't watching the hands. Thank you.
No, I know the attorney did notice, you know, it still makes me nervous when we have a trustee who says they've been, you know, after 25 years, they're still not sure, and eventually they'll understand all this. And when we hear, well, we are going to lose money, but not as much, we still have that same question about fees and hidden fees. We've never had anyone, any consultant, any manager coming in and saying, oh, well, it's not going to be a good year. They always tell us it's going to get better. It's a win-win. We're going to make it more. And then there's always an excuse. And we keep on adding and adding money. I'm still not comfortable with it. But if somebody after 25 years who, you know, who's been around longer than any trustee on this board still doesn't understand it, something's not quite right. Thank you.
No, Maria, I do understand it, but I don't understand it at a deep level. Like,
And
like Brianne does.
but we should, after 25 years and all the conferences and training everybody's had, we should be clear before we vote. And that's okay. I'm not disrespecting you, Trustee Riley. It's actually, it's a compliment. Because if I don't understand some of this and not quite everything, and you don't get it, then it means I need more learning or what have you. But that decision about
It's
fees is still a concern. But thank you. No,
Thank you, trustee. Thank you, trustee Rodriguez.
yeah,
I'm
let
gonna
me just finish. No, we started half an hour late. Come on, let me, and I waited, 3 people spoke before me. If you don't want to hear, I have to say that's okay. And I just want to make it clear with her, you know, I'm not being disrespectful. You didn't cut anybody else off, and some people spoke more than once. Thank you, trustee Weiss.
Okay, trustee Riley, sorry.
When I was saying it can get worse, in 1980, interest rates were 11% and then went up to 13 3/4 6 months later on a on an adjustable mortgage, but we were getting 16% on CDs. So, I mean, could it get that far? We don't know. If the federal, if the whatever sets the interest rates, I think he'd probably do it.
I mean, it's possible, but certainly, hopefully we don't get to that point, to 13%.
Yeah,
I think that he's kind of choreographed there, no expectations for cuts until at least next year. if at all?
Yeah, and remember, you're making a strategic decision over the next 10 years, right, or so. View this as you would a stock, right? You want to buy a stock when the stock is down here, and you want to sell when it's up here. Fixed income is giving you that opportunity now, although you have to look at it a little differently, right? Now we have higher yields. It's a great entry point. When you enter this asset class at higher yields, 2/3 of that total return experience is going to be comprised of those higher yields. You're going to accumulate those returns over time, and thus it enhances the return experience in this environment. So we do think it's a good opportunity to not only de-risk the portfolio by putting more money to work in fixed income, but also get a better return within fixed income going forward.
Thank you. Trustee Price Ward.
Yeah, that liquidity, that creates more liquidity. You know, that you can just go get money. My question is this, this switching to money off of all active, I'll make sure this is all active portfolio. What was going on with MWBE? Why were they not, why is this the opportunity for them to do better? They weren't doing better when we were in this, what we're in now. So what was the barrier? Or were we just going along with this with the NWBE doing this strategy?
So the State Street passive fund, so State Street was hired to run a passive index. They were given a requirement that this, X amount, is it 25% of brokerage should be directed through minority women-owned brokerages. They weren't able to meet that. They had agreed to do that, but then, weren't able to implement it. And so they've been on watch. That's part of the reason we're terminating them, but also we feel that active management makes more sense in this asset class. So there's two reasons we're moving away. And then your MWDBE active managers have performed well. So that part of the portfolio is working.
And remember that we take advantage of this process to look for opportunities to continue to enhance your exposure to diverse managers. And as I've said before, I'll say it again, and I'm sure I'll say it again in the future. You set a great example in the United States in terms of the opportunity you've given to diverse managers. Right now, your fixed income portfolio, 43% of it is comprised of diverse managers. With the changes that we're suggesting today, that's going to go up to 50%. So when we go through the fiduciary process of asset allocation, portfolio structure, that's an area of focus for us. We look for opportunities to continue to enhance that exposure. And this is one of those opportunities.
So this is a prime. So before, as interest was having going up, it wasn't high enough for us to get to this point, and we got to go through this process.
Right.
So this is the prime time.
I would say it's always a good time to invest in minority and women-owned managers,
I was just talking about the rates.
to add more to fixed income and do the structure. Yeah. Okay. Yeah.
Trustee Washington.
So just a real quick question. So with our thank you. I saw the M and the W and then I lost the rest of them, but with the alphabet doing what it's doing, is it kind of safe to say that because we are performing above the benchmark as well, right?
You are.
Through these managers. And so I just think it should be duly noted, because I do think that this speaks to the whole process of I guess this would this fall under ESG to a certain extent, as far as like I know that ESG is more, we're thinking environmental, but social, but also governance, which I guess this would fall under the G part of that with diverse governance or what have you. I'm kind of thinking out loud, so forgive me. But that stuck in my head, because I do think that while there are people out here that say that they can't find diverse managers, this is proof repeatedly that there are diverse managers out there that know what they're doing. And it's beneficial for for pensions and for funds when they're being utilized in the most prudent and efficient way.
Sure.
So-
And that opportunity set has actually grown over the years, where now you have a lot more choice, particularly in this case within core fixed income. Within Core Plus, there are still opportunities for organizations to continue to grow in that area. But in this process, in spite of that, we are confident that within core fixed income, there are plenty of opportunities to explore to continue to enhance your exposure in that space.
Do you know our policy standards offhand? What is the, in our, financial statement?
Somewhere around 25%, and you're well above.
We're well above that. Okay. All right, good. Yeah, Victor.
I think the thing to mention is also this puts some meaning into the watch list. I mean, you could just end up there forever. So when we do these kind of things, this says something. So I think that's an important message.
Yeah.
Thank you.
Okay, shall we get into the structure analysis?
Please.
Okay,
Thank
so
you.
I'm going to start on page 8. Now, before we dive into details, if I could summarize what we're trying to do with one sentence, I would say we're just trying to optimize the portfolio. And what that means is we want to be compensated for risk. We want to be compensated for the fees that you're paying. That's it. That's what we're doing. Now, if we take a step back, as Brianne mentioned, you approved an asset allocation that de-risks the portfolio. What that means is we're removing resources from equities, particularly international equity, into fixed income. That explains 90% of the volatility that you'll experience in this portfolio. So what we're talking about today is just changes at the margin, structural changes to help optimize the portfolio, to help get compensated for relative risk and get compensated for the fees that you're paying. Let me hit the fee issue first, because I want that to be very clear to the board. Because we're moving money away from SSGA, which is a passive strategy, into what I hope is an MWDBE core manager, right? An active strategy, your fees will go up marginally in the order of 3 basis points. So you're going to go from 12.5 to about 15.5, 15.6 basis points estimated, right? We need to do the search, we need to negotiate the fees, et cetera, but just to give the board an idea of what we're talking about. However, we are confident, given the empirical evidence Brianne reviewed with you, that an active approach will enhance your opportunity for excess return generation. Let's take a look at your history, because I want you to see the proof statement in front of you. So why don't we go to page 14. Thanks, Brianne. Way out here. Let's go to page 14. Let's just take a look at a set of numbers. All the way on the top of the table where the fixed income composite is, go back to the last 10 years. You see that 1.84 versus the 1.52? You see those two numbers? All the way to the right in the top, 10 years. 184 is your actual net of fees annualized return over the last 10 years, okay? Above the benchmark of 1.52. So you've outperformed net of fees by about 30 basis points every year over the last 10 years. So the trade here is, give me 30 basis points, I'll give you 3. And let's do that every day. I'm going to win, right? That's what we're doing. We're suggesting an active manager here to continue to enhance that 1.84. The fees go up because active managers need to be compensated, but we need to be compensated with excess returns. So we are very comfortable and confident that this strategy will make sense for you going forward. Does that make sense? I know the fee can be a sensitive issue. I wanted to address that head on.
So let's just halt for 1 second. Let's see. Are there any questions regarding fees that anyone wants to bring up? This is your chance to bring them up, because I know people have a lot of strong feelings about these. Yeah. I'm looking at it right now, so Okay, any questions on what we're hearing here?
Okay,
I think we're good. Thank you.
good. Give me 30, I'll give you 3. Let's do that every day. I'll win. So the objectives are set out on page 4, and you can see here that we're trying to analyze the overall structure of the portfolio, which today is comprised of page 8. Thank you. Is comprised of 60% core strategies, 40% core plus strategy. One of the key objectives is to remove that passive strategy managed by SSGA for reasons I just explained. We want to enhance the opportunity set within diverse managers, and we want to be conscious of the exposure of the fund to all active managers at the strategy level. So your investment policy imposes a limit of 20% at the total firm level, where, for example, if a firm had $100 in assets under management, you cannot exceed more than $20 in that firm with that manager. We are actually imposing here or following a more conservative approach where we're looking at this limit at the strategy level, just to manage organizational risk. If the strategy fails for some reason, we don't want you to be a significant component of that strategy, okay? So the structural changes that we are suggesting help us get there, okay? And then, of course, we'll work closely with staff to negotiate fees as necessary, given the fact that you have $1.3 billion coming in. Please, go ahead. Please.
So in terms of the strategy limit that you mentioned, Angel, are we talking about strategies across managers or with a specific manager?
With a specific manager. Very good question. So, you know, the manager has $100 in total firm assets under management, and this particular strategy we're talking about represents 10 of those dollars. You can't be more than $2 of that strategy. Yeah. Okay, so it's a conservative approach that we're very comfortable with. Now, on the following page, page 9, we summarize some of the key attributes of your current structure and the proposed structure. So if you look at the top of the table, the split between core and core plus today, as I mentioned, is 60% core, 40% core plus. We want to switch that. We want to do 40% core and 60% core plus. Why? Because core plus presents an enhanced opportunity for value creation. That 1.84 you saw, a big component of that is coming from core plus managers. I mean, it's the collection, it's the effort of all of these managers together, but core plus gives you an enhanced opportunity for alpha generation or excess returns and for consistent value creation relative to the index. The number of managers will remain the same because we are repurposing one of the managers, and then that opens the doors for an active search for that core manager I mentioned earlier. The target in passive fixed income goes away, so that goes to 0. We move to active managers, and we achieve all of the goals that we discussed on the prior page. As you go through each line item on this table, you can see that affirmative, given the changes that we are suggesting, these changes help us achieve those goals and objectives. Let me pause here and see if you have any questions or observations. I'm not going to read the table line by line, I promise you, because I
think
don't want to bore
you're
you.
good. Let's see if there's any questions. And I guess one question, because we're moving more to core plus, are we being compensated for additional risk, and how much risk are we taking on, right, by having more in core plus? Is that something we should be concerned about?
Well, I think the evidence in your portfolio is that your core plus managers have in fact outperformed. And what we find attractive about not only putting more money to work in core plus, but also repurposing Wellington from core to core plus is that Wellington does something slightly different than the other 2 core plus managers. I mean, they're all kind of doing the same thing. They're investing in out of benchmark positions in high yield and international. But when you look at LM Capital, they do a lot of EMD, emerging markets in Latin America, for example. When you look at WAMCO, they do credit securities. They're very good within credit. and high yield. Wellington adds exposure to bank loans and convertible bonds. So it enhances the portfolio, diversifies the portfolio even more from that perspective. So overall, Trustee Weiss, the Core Plus opportunity gives you enhanced returns and excess returns, and those returns have been compensated for risk, and we're comfortable that going forward, these managers are well equipped to do just that.
Okay, thank you.
Sure.
Just wondering if, do you agree, do you feel the same way, Fernando? I want independent fiduciaries each to give their own opinions. So
Sure,
do you feel the same way as Callan?
I do. We've had
Okay.
several conversations about this, have had time to really explore different structures and discuss all the different impacts to the portfolio. And again, the biggest thing is going back to, we're just trying to right size the ship a little bit. We're at 18%. The original target was at 23. So even if we didn't have that new target, we still would have to rebalance because we're at 18%. That now that we've moved to 26%, that's why, it seems like we're moving a lot, but it's a combination of that, plus we're moving from passive to active. So it seems like a big number, but we're at a low point as well. And we're accomplishing that objective of addressing the watch list and taking advantage of the fact that, again, if someone's giving you a guaranteed 5% today versus taking a risk on something that you don't know what they're going to give you tomorrow, I think I'll take that 5%.
Okay, thank you. Trustees, any questions on that or any comments? Yeah.
I'm sorry, what's the, I guess, the term of this strategy? Is it like, because I heard something about 10 years, is it 3 year? How long is the strategy? What are we thinking about in terms of?
It's kind of an evergreen, forever in perpetuity type of thing. I mean, ideally, these managers do it.
Just in the market change.
Well, what we want to do is we want to kind of revisit the asset allocation and the structure every 5 years or so to make sure that we account for changes in the overall economy and, as a function of that, the markets. So I would say that for now, this observes a 10-year window, but we're going to revisit this periodically going forward.
All right.
Thank you. Any other comments or questions?
And then the last page,
Oh yeah, I'm sorry, Maria.
Maria,
I'm watching you, Maria. Sorry. Trustee Rodriguez?
Yeah, I'm trying to mute myself. Okay, so you're saying it's a 10-year and you said now it'll be a 5-year watch moving forward. Was this the same path? Is this a past practice or something new that you want now?
That's a great question. So this is consistent with the fiduciary process that this board has followed historically. So we want to make sure that we observe the asset allocation of the fund at least every 5 years, preferably between 3 and 5 years. And as a function of that, also take a look at the structure. So this is consistent with best practices and past practices as well.
Well, actually, it's a more recent past practice, the last couple of years, because there was another trustee who's no longer on there. When we changed, well, some people voted for the change, but we would review everything even less than 5 years. And if I'm not mistaken, we would monitor everyone and it was more frequent. And then it was changed to 5 years, and which I'm not comfortable with. So, but even 5 years is kind of a stretch. I don't know, but again, that's what the board voted for. That's what they voted for.
Trustee Rodriguez, do you have just on the record, do you want to make a recommendation then?
I don't have the votes, I think it should
No,
be.
I'm saying, I want you to get your voice heard. That's what's important here. So you want to shorten the time frame?
Absolutely. I would be comfortable with 2 to 3 years.
2 to 3 years. Okay, I just want to know where you stood.
Yeah, okay, I'm a recommendation. Would anybody, or make a motion, would anybody support that?
Oh. It's not on the, yes, hold on, Trustee Rodriguez, sorry. Yeah, Mary Sharon.
No, I was going to ask, our portfolios are monitored, 100% of the time by our staff, our consultant. And if anything is going wrong, they would be brought to us. I think that's one of the reasons we did shorten the time. Granted, I'd love to hear about it. How many managers do we have? Do we want to hear from all of them every 2 years? I'm sure that would make you happy, Maria, but I don't think that's practical.
Well, you can't, assume what I'm thinking in my head that'll make me happy. It isn't what'll make me happy. It's all about transparency. Because in a statement at a full board meeting, we were told, well, that would take up too much time. Well, we have a whole team where, we have a whole investment department, and things, maybe it's everything about scheduling or working things out. But to say, well, it would take too much time, when if this were like, if everybody at the pension office were, they were volunteers like we were, but people get paid for this. It's all about timing. There's other things. I think there's other things in that team that more time is spent on other things, and our investments are the most important. We don't have those investments, and we're not monitoring. And it's transparency. Maybe they know, but we need to know too, also more often. And the public needs to know. People who those of us who made over 34 years of contributions. So to me, it's bottom line is transparency. And for people to say all the time, well, these are experts in any department, any vendor, I'm not just talking about investors. Well, they're the professional, they're the experts. Well, if they're the experts, why do we even need a board of trustees? We have to approve everything, but we're supposed to monitor and go through everything. So much for that said.
Thank you, Trustee Rodriguez. I'm wondering if this is a policy, it would be held in another meeting, but I've got a number of trustees' hands up here. Let me
Fine.
get down the line.
No, thank you. Thank you for allowing me the time to speak like all the other trustees. Thank you, Chairman Weiss. Thank you.
Thank you.
It is on the agenda for board action, by the way. I thought you mentioned that you didn't think it was on the agenda for board action. I see that the agenda I have.
I don't have.
They were posting it up there, but it's not the same board action. I think what.
Hold on one second. Let me go down the line here.
I think I heard 3 to 5 years, but I'm really doing most of my time with Angel because he had thought, and I wanted to make sure he expressed that, because explanations, but I thought I heard 3 to 5.
It's not for the policy. I thought she was.
Sure. Well, thank you.
Okay.
I guess I want to make a distinction here of different aspects of what we're doing, right? So we're talking about asset allocation, portfolio structure, and monitoring, okay? Monitoring happens all the time, particularly on a qualitative basis. When something happens, you'll hear from us. So the portfolio is being monitored on an ongoing basis. Asset allocation, remember, when we're shifting things around, there are costs associated with that, okay? So yes, of course, we can take a look at the asset allocation every 3 years. That is absolutely acceptable. But we don't want to make changes so frequently unless something really happens that forces us to go there. Portfolio structure changes should follow the asset allocation. Why? Because you don't want to make a structural change, then do an asset allocation that forces you to undo what you've done. That translates into unnecessary transaction costs. So I think the rhythm of 3 to 5 years, or 3 years if the board wishes going forward, for asset allocation and portfolio structure is appropriate, and it's also consistent with best practices. I just wanted the time to make a distinction about those different things.
Yeah, and if I can add, there's been a couple of things. So sometimes there will be a change in the contribution policy or benefits at a plan that will also trigger a review. We did do an asset liability study in 2021.
Yeah.
Yeah, and we decided to stay with the current asset allocation at that point. However, we've since reviewed it again and looked at this opportunity to add private credit. So it's on, we wouldn't normally do them that often, but there was a change in the contribution policy. And now we've had a change in, staff coming in saying, we'd like to look at private credit. And I think that was a very good, catalyst for us to redo the asset allocation study. And so that's where we are today, is looking at it more frequently. But there is a balance, to Angel's point. You don't want to be doing this all the time, because then you're not giving the structure or the asset allocation enough time to work.
Thank you. Thank you. Let me just put up hands so I know who's who here. Riley, please, and thank you.
One of the examples where I think we were remiss in follow-up were the African investments. It was too long before we heard from them as a new manager. And I would like to have heard from them a lot sooner, and I would like to hear from them more frequently because it's a different type of asset class. And we need to follow them more closely. Because I think they kind of showed they weren't doing well when they presented, but I guess they are actually doing well. And it had to be, but that has to be brought to our attention. How? So I'm not saying we shouldn't do it, but I think we should have our professionals do it and bring to our attention things that aren't working. Thank you.
Hold on one second, Trustee Rodriguez. I think that's a very good point, but if we know, like with these African or other investments, and there's geopolitical risks and the currency fluctuates or something's going on that is worth knowing about, right? Please bring it to our attention sooner than later, right? We don't want to find out that something went wrong and we didn't know about it for an extended period of time because then, you know, we weren't properly alerted to what's happening if we're going to take action. So yeah, just if there's something happening, more information is better than less. Okay. Trustee Rodriguez, please, and thank you. Or is your hand up from before?
I'm unmuted. Gives me a second. My button here on the laptop is slow. As Angel mentioned in talking about monitoring managers, and I won't say a name, we have a manager who's been a real roller coaster ride and it has not performed. And it's well over, it's good Lord, at least 18 years. So reporting it or talking about it, knowing about it, but no action is taken. That's why I'd like to see some of these recommendations, and they shouldn't be taking so long. And the African investment, as Trustee Sharon Riley mentioned as well. I brought that up at I believe it was the last board meeting. As trustees, if you guys are the experts, anybody in the office, we shouldn't even have to be asking these or making these suggestions or recommendations. And that's my concern. It should be out there, total transparency. So we can have a better understanding when we come to the meeting also. Thank you.
I think there needs to be a little bit of response to that. I don't think there's been any managers. Do you want to respond? I mean, I don't know if that's a true statement.
I'm not sure what manager specifically we're talking about, but if, for example, one of your managers within domestic equities employs a very aggressive growth strategy, and by definition, that manager is going to be all over the map. But this is the one manager that when growth is in favor, gives you a 40% return. And when it is not in favor, it gives you a 30% loss. But it's a small component of a bigger picture. And it plays a specific role within the portfolio. We have no concerns with this manager from a qualitative, research, or quantitative perspective. Some of these managers by design will employ, you have a combination of managers that are conservative and others that are aggressive, and that's what you want for diversification purposes. So the ride can be pretty substantial sometimes, and we've actually terminated managers in the past where the board has felt uncomfortable with the level of relative volatility. We're always happy to have those conversations, but from where we sit today, we have no concerns with, if I'm thinking about the manager that we're talking about here.
So, well, yeah, let me just respond. If anyone, as staff or trustees, feel that we've in any way violated our policy statements or our policies, please bring it to everyone's attention, okay? There should be, this is a transparent process. So if there's something we miss, no one's perfect, but let's bring it to light, okay?
So for the record, we have not missed anything. We have a watch list process. All of the managers on watch are listed there. We review those managers on a quarterly basis with the board. Nothing has been missed.
Then perhaps everyone has to read their internal messages that we've been receiving.
Okay, I'm gonna move on here. Trustee,
Thank you. Yeah, I was just sitting here thinking like some of this, I mean, this sounds familiar because we had conversations about specific managers that were on watch and all that stuff. when Victor and I joined the board, that was one of the earliest meetings that we had was about the watch list and everything, to the point that you just made. And I did hear you say this asset allocation process would be reviewed every 3 to 5 years as we're watching, because it takes the cycle was about 3 years to see an allocation kind of work, right? And so my question is, don't we, like we get, what do you call those things? Well, a report. We can look, it's posted on our website, what investments we're in and the performance of what those investments are doing. That is public information. And so I thought that's what we had. And I just want to be clear about that to make sure that I'm not imagining something, because I do think that it's important that as we are in a public meeting, that the public that may be listening or may review the tapes later, understand that this information is already available. And I do think that it is incumbent upon staff that we are paying to do that. I mean, not to be, that's what we pay you to do. And I believe that that's what you're doing. So I expect that when I'm in my classroom, y'all are making sure that the money is together. And if something is wrong, we get an alert, text, call me if we need to make some quick decisions, because that's what we're all here to do. I think it's important for us to all remember what our responsibilities are. And it's not my responsibility to figure out if the investment is, that's way out my purview. I'm learning as you all are teaching us, and I appreciate that, but I expect your expertise to inform our decisions. That's why we have consultants and a CIO and an executive director, because it's my understanding that you all are doing that job. And so far, I haven't seen that to be an issue, because the markets are volatile. So I just think that we need to make sure that we're being very clear about what we're saying about how our monies are working, because we don't want to give people the impression that something is going amiss and the board is being negligent in our fiduciary responsibility to make sure that our money is right. Because some of y'all sitting on this board are already getting this money, and you're going to get it till the angels call your name. And I expect to be able to get mad 13 years from now, because I'm not going to understand if it's not here. So that being said, I think all of us sitting here are very clear on making sure that we're doing our part to make sure that that things are going as they should in a market that is all over the place, in a world that is full of chaos. And I think that our people are doing the job that we should be doing. And so I just kind of want to be clear and I guess put that on the record, because we like to put things on the record, but I want us to be clear that when we put stuff on the record, it should be accurate and factual, because I don't want it to ever be implied that somebody's not, that we as a board are abdicating our responsibility and allowing staff or investments to just run amok with no checks or balances. We have more policies probably than the federal government on how we move money and all that stuff. And I think that it's important that we respect our processes and also respect the people that we have hired to do this work.
Okay, thank you. Thank you. Let me go down the line. Price Ward, please. Thank you.
Let the record show nothing has been missed, and I would recommend we move the agenda.
All right. Carlton, did you have any?
Yes, and I was just to confirm, this portfolio has outperformed for all periods, the 3, the 5, the 10, the 15, the 20, and it's over 8% return life to date. So nothing's been missed, and the portfolio is outperforming the benchmark.
Thank you. I think though the question is, do we miss anything in the due diligence process? I don't know of anything that we've missed. If anyone is aware of anything, I would say bring it to light so that we can address it. Because that's part of our duty, our care, prudence, and diligence duty as trustees, right? Trustee Ochoa, please.
I just want to make sure we let them finish and.
Yeah, we're moving on here.
Yeah, just.
They don't even have any water here. We're working them hard, so.
Yeah,
One more slide
Trustee
and we're
Rice,
done.
one quick comment since you made a like I said, people need to read their internal emails. And then everything will be clear. Thank you.
Thank you.
Okay.
You guys doing okay?
Oh, we're doing great.
All right.
Any other comments or questions? Otherwise, I'll move to the last slide on page 10, and this basically talks about next steps. So how do we get there? How do we get to that proposed structure? Well, number one, of course, the board should vote to accept this new structure. At a very high level, we're moving away from passive. We're moving the split from a 60 core, 40 core plus to a 40 core, 60 core plus. We're going to initiate a search to identify a new core manager, and we are repurposing Wellington. We're comfortable as your consultant with all of those recommendations, okay? So the first step is to approve that. Then, of course, we'll work closely with staff to initiate fee negotiations as a lot more money is moving into fixed income. These managers now have a lot more economies of scale, and the savings should be transferred to you, the client. So we want to make sure that to the extent we can negotiate fees, that we do that. We will initiate, working closely with staff, a formal RFP process for that core bond search I alluded to. And then we think it's very important to identify a qualified transition manager to help us move all of these moving parts. That is the responsible thing to do from a fiduciary perspective. The transition manager becomes a fiduciary to the fund during that transition process, and their job is to do this in an organized fashion and also, to the extent possible, manage both implicit costs and explicit costs. And of course, that is the responsible way to do that. And in that process, SSJ will be terminated and we'll get to that destination portfolio. So with that, I'll pause here. Our recommendation is for the board to accept the new structure, and then of course, we'll follow through with the next steps as necessary.
Okay, I don't have a motion in front. Was I supposed to have a motion to approve this?
Yeah.
Okay, I don't, is there the language or do we have a page? I have the other. Oh, the board, I'm sorry. Approve proposed fixed income structure plan. So the recommendation is approval of the proposed fixed income structure. Do I have a motion to approve that or a second? So move.
Second.
Thank you.
Can I ask a quick question?
Yes.
So just so that I'm clear. So now we're approving this section and then you all will bring us managers that we'll decide on who to, that's what I thought. Okay, thank you.
Can I get a roll? Oh, sorry.
Again, I appreciate you guys.
We love questions.
Allowing me to ask what may be something that's known to everyone. Okay, so you said a qualified transition manager. How is that person's role something that we don't already have covered, I guess, through our internal investment committee or through you guys? What do they do and why can't we use you to do it?
Sure. So you already have a bench of qualified transition managers, and now it's a matter of evaluating which one of those managers will present us with the best possible outcome in terms of fees and costs to get us to the destination portfolio. So I'll give you two extremes to help you understand the role of this manager. If anyone took the responsibility to move $1.3 billion around and you made that call wrong, you are in serious trouble from a fiduciary perspective, right? So we want a professional organization to take on the responsibility to say, okay, here's the portfolio today, here's what we need to get, those moving parts, let's manage that to get to that destination in the most efficient way. That's the role of that manager.
And the other thing, just to add to that, Trustee Vincent, so when we are getting ready to do that transition, we will come back to you and present the game plan, as well as, I don't know what the process is if we finally get to who we choose, but we may even show you the different bids that we get to see, to show you what we recommend, whether it's the best cost provider or the most efficient, but you will see the interim process before we actually execute that transition.
Okay, I kind of went out of order here because we're in the middle of a roll call, but I wanted to give you a chance to speak, so.
Oh my gosh.
Roll call, please.
Okay, just to be clear, we had.
It's a recommendation to approve, oh, I'm sorry. Oh, no, just to be clear, it's recommendation approval of the proposed fixed income structure plan. That's what we are voting on. Thank you.
We had the motion by trustee Benson and the second by trustee Washington. Is that correct?
Correct.
Thank you.
That's proposed as is with no amendments, right?
Correct.
Okay, just making sure.
Trustee Blackwell,
Yes.
trustee Ochoa,
Yes.
trustee Price Ward,
Yes.
trustee Riley,
Yes.
trustee Rodriguez,
No.
trustee Benson,
Yes.
trustee Washington,
Yes.
trustee Weiss.
Yes, thank you.
That's 7 ayes and 1 nay.
Thank you. Very good. Thank you. Thank you all.
Thank you all very much. Appreciate it.
Get a Gale cupcake on the way now.
Remember, I'm a sugar-free guy.
Get the oatmeal. Okay. All right, we are moving on to item 6, which is our international equity search update. Our very own Fernando, and I don't know if Kelly is also presenting or not, but.
Thank you, trustee Weiss. So this is just an update on the international equity RFP because it's been a while since we initiated it, and just to let you know and level set expectations of what you can expect going forward. So if you recall, we kicked off the search, and the search is almost like 3 searches in one, because we invited responses for managers that do both growth, value, and core. So what we are planning to do is we are going to bring in 3 sets of finalists. We've laid out in the next steps when we expect to bring them in, so that you're not overwhelmed. We didn't want to do it all in one meeting. That's actually potentially 9 finalists that would present in one meeting. So we broke it up over 3 meetings. So the first one will be in December for international equity value finalists, and then the ensuing ones will be for the January and February meeting. So that's where we're at. Again, 66 responses, a total of 72 different funds that's on offer. Callan is doing the kind of we're talking to them and trying to narrow it down so that we can do our due diligence, a handful, not all of them. But we're trying to find a way to categorize and put them in the right place, and so that we can do deeper due diligence on these finalists. And again, the timing is laid out here on when you can expect for us to bring them back to you to present. And at that, I'll take any questions if there's any.
I think we're good.
Okay, great.
Nope, I think we're good. Let me look down. Yeah. Very good. Anything else?
None for me. The final 2 items are more written. And I think for the November board meeting, Callan will be coming in with the 3rd quarter performance. Is that right? Or are we moving that to December? December, sorry. Yep.
Thank you. Thank you. Do you want to, before you leave, do you want to say anything about the private equity performance? I know it's in written form, or should we want us just to review it? Or?
No, I don't have anything to call out. It is 1st quarter. Going back to the discussion about manager reviews and due diligence, again, staff, at least on the traditional side of the portfolio, the publicly traded side of the portfolio, we do meet with each and every manager every quarter. So I want to be clear that I think there's been quotes out there that say we don't have enough time. It's more that we do not, the board, don't have enough time to meet with every manager. We cannot bring in every single manager to present to you. That's just not feasible. It would not be the best use of your time. I think that's the misnomer that's going out there. However, staff every quarter meets with every manager, and there are notes. At least on the private equity and alternatives, because they do have a longer life to them. It doesn't make sense to necessarily meet every quarter because there's not a lot of changes necessarily. But we are trying to find ways to be able to bring to the forefront anything that is of concern for some of those longer dated investments. So we are working on that.
Thank you. Let me see if there's any questions from any trustees here before I let you go. Sorry. Trustee Rodriguez.
Okay, so then I think possibly, and no disrespect to you, trustee Weiss, but a perfect example when you said, oh, is there a motion? Is there a recommendation? Where's the motion? You're the chairperson and you should have known that there was a recommendation. And what Fernando just stated said, well, it's going out there about we don't have enough time. You need to listen to the tape or what you said, that you're the one that told us that we don't have time to meet with everyone. Now, was your statement not clear, or was it just a brief statement? You did make that statement, and everybody, people were asking, what's that about? I said, I don't know. I had to go through everything, but you are the one that made the statement. It's not something that was initiated from a trustee, just for the record. As I usually say something at meetings, just for the record, to be placed in the minutes, and twice, I'm not quoted. Another trustee made a statement right after I did recently, and they said, for the record, it'll be interesting if there's discrimination. One trustee can say, I want this be stated in the record, if that statement will be in black and white, and if my statements, when I say for the record, and I want that in there, if they're going to be in there. Thank you.
Thank you, trustee Rodriguez. I think we're good. Thank you. We're gonna move on. All right. Any unfinished business, trustees? Anything, please?
Just briefly, because I didn't get a chance to speak, Gail stepped out of the room when we started the meeting. I wanted to thank her for her 39 years of service and let her know how much we appreciate her. When I came here in 2010, Gail, Sharina, Cecilia, Cheryl were a part of the group of people that helped keep me afloat. Mary Sharon also through some of the rockier times that we had here. And when I needed somebody to talk to, I always had Gail and other people that I mentioned. But again, I just want to thank you for your service and being here, and hopefully you'll stay longer, as longer as you can possibly want to stay. But we really appreciate you and your service here.
Thank you, President Blackwell.
President Blackwell.
All right. I just wanted to add to that. I'm sorry, Gail, I was holding my breath because I thought you were gonna tell us you're leaving. You scared.
We were all holding our breath.
I had to grab Jeff's arm. I said, wait a minute, what is she talking about? You can't go anywhere. But, and I do appreciate your service.
Thank you.
Yep, I see her. Mary
I-
Sharon.
When we're talking about Gail, we can't neglect to say that she's raised a wonderful daughter who is now in the public eye all the time, and she's moving up and up and up, and she's only 31 years old.
Yes, thank you. Thank you, trustee Riley.
All right, any new business, anything that needs to be brought to attention?
Just keep watching Channel 7, by the way.
Okay, motion to adjourn.
So moved.
Second. Second, will you?
I'll give it to Maria since
Well, I'm the only one who said second, but thank you.
weren't,
No,
but
you're not,
okay.
but-
I know it happens all the time. when I'm in
Wait, who made the
person.
motion? Who made the motion? I'm getting lost here.
I just,
So sorry, Mary Sharon. Second, Rodriguez. Please give it to Rodriguez.
guess I'm cutting my own head off here.
Roll call, please.
Okay, trustee Blackwell,
Yes.
trustee Ochoa,
Yes.
trustee Price Ward,
Yes.
trustee Riley,
Yes.
trustee Rodriguez,
Yes.
trustee Benson,
Yes.
trustee Washington,
Yes.
trustee Weiss.
Yes,
That concludes roll call. 8 ayes.
meeting is adjourned. Thank you. Thank you all.